everyone, and welcome back to another Stocks for Teens video. Today we're going to be continuing our lesson with technical analysis, but before that, as always, I have another stock quote for you. This time from Peter Lynch, who's an American investor, mutual fund manager, and a philanthropist. Peter Lynch once said, "Know what you own and know why you own it." It's important to do your homework before making big stock decisions, and that's why all of these types of analysis exist. It's to help you make the best decision possible in the stock market. And after you've made your decision, be sure to recheck your stock portfolio in a timely manner, because that will not only help you prevent mistakes in current times, but will also help you prevent mistakes in the future. And with that in mind, let's get started. So today we're going to continue with our lesson with technical analysis, but first let's have a mini review. Technical analysis is the study of historical market data, including price and volume. It basically forecasts the direction of future price movements, and it helps investors to evaluate their investments using this historical market data. It purely references charts and indexes, which I've covered in the last video, and if you don't remember specifically what charts and indexes I've covered, then go check out my last video, Technical Analysis Part 1. The major point I want to re-emphasize here is that technical analysis is not fundamental analysis, although these two methods both help investors evaluate their investments. Fundamental analysis, as I've covered in a previous video, is the process of determining a stock's real or fair market value by looking through a business's perspective, such as looking at a company's financial statements and ratios of those sorts. Technical analysis, on the other hand, is purely empirical evidence through historical data points. Now that wraps up our review, so let's get started with our next topic within technical analysis, price patterns. Now, price patterns are trends that occur in stock charts. More importantly, they represent the transitions between rising and falling trends, which are then summarized into patterns, making it easier for investors to understand and perceive. Now, why are price patterns important? Patterns are the distinctive formations created by the movements of security prices on a chart and are the foundation of technical analysis. Without price patterns, we wouldn't be able to gain a better understanding of what might happen in the future regarding a share's price. This is the really interesting part, but price patterns can be represented through shapes, the first being the triangle price pattern. This price pattern is rightly named because it looks like a triangle, as trend lines are depicted along a converging price range. This converging price range indicates a pause in share prices. There are three potential triangle variations that you can see here, and those are the ascending, the descending, and symmetrical triangles, all of which are on the slide right here. The ascending triangle has a positive linear regression, which shows that this price range is part of a bull market range, where prices are constantly going up as investors buy and sell their stock. On the other hand, we have a descending triangle pattern, which is denoted by a negative linear regression and represents a bearish stock market, where investors are buying higher and selling at lower prices, which is actually a useful indicator as people can avoid taking part in this pattern because you wouldn't want to invest in higher prices and sell at lower prices. Finally, we have the symmetrical triangle, representing a period of consolidation before the price is forced to break out or break down. We can see how prices are starting to become narrow and reach a specific price flat line, which then fuels a breakthrough for new price patterns to occur and sort of break this bullish trend. Now, moving on to rectangle price patterns, which, as you might have guessed, represent rectangles. This price pattern occurs when there is significant support and resistance. If you're wondering what these two terms mean, support levels refer to the price levels that an asset does not fall below for a period of time. For example, if buyers continually buy and sell at a price range of $35 and prices do not fall below this share price, then the support level would be at $35 for the share. Resistance demonstrates the opposite. This level represents a price point that an asset has had trouble exceeding in the time period being considered. Support and resistance might be temporary or long-lasting, as it depends on investor confidence during the time being. Now, support and resistance relate to the graph's trend lines as they contribute to the horizontal nature of the graph itself. That's why you see a rectangle. Price patterns keep fluctuating up and down from the same points, which is why a rectangle is formed, and usually people wait for a breakout to occur so that the same trend doesn't happen over and over again and prices start to either escalate or go down. Finally, we have the head and shoulder pattern, which even though it might sound complicated, actually isn't. I would say it's the simplest trend to interpret. The head and shoulder pattern is a chart pattern described by 3 peaks. The outside 2 are close in height and the middle is the highest. This pattern is a technical indicator and represents the reversals in the bull and bear markets. As from going from left to right, prices increase, which is that of a bull market, and prices then decrease from the head to the shoulder, that of a bear market. Stock prices in this trend are a result of how many people support the bull movement and how many people believe in the bear trend. If more investors are likely to support the bull movements and invest in higher prices, then this pattern breaks and prices escalate, and the opposite occurs when more people support the bear trend. The second and final topic that we're going to be covering today is trends. Trends are relatively simple as they represent the direction in which prices are moving. An uptrend to start off is an overall move higher in price, created by higher swing lows, represented by the troughs here, and the higher swing highs, represented by the peaks. This is a trend that traders can take advantage of by buying during pullbacks or at beginning of rising prices to capture profits. The downtrend is the reversal of the uptrend, as they are characterized by lower peaks and troughs. Downtrends can be caused by various factors such as macroeconomic changes or business deficiencies. The overall message here is that more people want to sell instead of buy because of decreasing investor confidence in that particular stock. Finally, a sideways trend is the horizontal price movement of a stock between resistance and support levels, like that of a rectangle pattern that we discussed earlier in the video. Traders can profit from sideways trends in several ways, from looking for confirmations of a breakout or breakdown to using stock options to place stop-loss orders when the price nears resistance levels. Before I finish off this video, I just wanted to do a final reflection of all topics covered in both parts of technical analysis. The core principle you should always remember is that market price reflects all available information that could impact a stock market. This is why people don't believe that they need to look at all of the tiny itty-bitty stuff, such as company reports and a company's development and the advancements they make. That's more for fundamental analysts. The 2 major types of technical analysis are chart patterns and statistical indicators. Technicians attempt to identify areas of support and resistance using chart patterns, and these patterns are heavily influenced by psychological factors. For example, the triangle, rectangle, and head and shoulders pattern that we all covered today in this video all predict where prices are headed following a breakout or breakdown from a specific price point and time. Finally, technical indicators are a statistical form of technical analysis where people apply various mathematical formulas to prices and volumes. The moving averages sections that we covered in the last video are technical indicators, and they make it easier to spot patterns. For example, the simple moving average and the MACD. And these are all calculation based. And that ends our series for technical analysis. As always, thank you so much for watching this video. If you found this video to be useful, then hit the thumbs up button. Share this video with others who you might think are interested in technical analysis, and most importantly, subscribe to my YouTube channel Stocks for Teens if you haven't already. If you have any comments, questions, or concerns that you'd like to let me know, then leave it in the comment section down below, but if not, see you next time.